How does the ECB Governing Council affect inflation? Imagine a group of people making big decisions that can change the prices of everything you buy. That's what the European Central Bank Governing Council does for the Eurozone. They are responsible for keeping prices stable and making sure inflation stays around 2%. But how do they do that? Let's break it down. The Governing Council sets the main interest rates, which are the rates banks pay when they borrow money. When they raise these rates, borrowing becomes more expensive. This usually slows down spending and investment, helping to keep prices from rising too fast. When they lower interest rates, borrowing gets cheaper, encouraging people and businesses to spend more. This can help push inflation up if it's too low. They also use other tools to control the economy. One is open market operations, where they buy or sell financial assets like government bonds. Buying assets injects money into the banking system, making it easier for banks to lend. Selling assets pulls money out, making loans harder to get. These actions influence how much money is circulating, which affects inflation. Another tool is asset purchase programs. The ECB buys financial assets to add liquidity to the economy. This encourages banks to lend more money to businesses and consumers, boosting demand and helping to raise inflation if it's below target. Conversely, if inflation gets too high, the Council can sell assets to reduce liquidity and slow down price increases. The Governing Council also gives guidance about future policies. They tell markets what they plan to do with interest rates or asset purchases. This helps people and businesses from expectations about inflation. If everyone believes inflation will stay close to 2%, it becomes easier for the ECB to keep prices stable. Since 2021, the ECB has aimed for a symmetric inflation target of 2%. This means they are equally concerned about inflation going above or below that level. They are ready to act strongly to keep inflation close to this goal. When inflation rises well above 2%, the Council might increase interest rates and reduce liquidity. This makes borrowing more costly and slows spending, bringing inflation back down. If inflation stays below 2% for a long time, they might lower interest rates or buy assets to stimulate demand and push prices up. All these decisions matter because stable inflation helps keep the value of money steady. It supports economic growth and keeps employment steady. The Governing Council's actions influence the prices you see in stores, the cost of loans, and the overall health of the economy in the Eurozone. In short, the ECB Governing Council affects inflation by setting interest rates, managing liquidity, buying or selling assets, and guiding market expectations. Their goal is to keep inflation close to 2% so that prices stay stable and the economy can grow smoothly.